At the beginning, you suggested that you maybe felt they wouldn't be feeding through directly into mortgage rates, which is obviously what we care about on this show.
Yeah, I advocate and personally use 5-year fixed rate mortgages because they take out volatility. 2-year fixed rates are for speculators, really. And they've also got a lot of fixed costs these days, valuations, solicitors. It all gets more and more expensive as professional services escalate. But ultimately, the 5-year is only dictated by a relatively small amount by the bank base rate. So we need to be cautious. We also need to be cautious because the price of money is set by the swaps market as a rule, which is related to the gilts market, which is related to the bank base rate, but they're not exactly the same thing. And for the past 2 years or so, the swaps market has been trading at a reasonable discount, about 35 basis points to the 5-year gilt. Now, this is really a measure of supply and demand and confidence in the marketplace. So it's had to be the case that the swaps have had to be discounted because there's been a lack of mortgage demand. If that mortgage demand picks up, that discount can easily, that gap will narrow and potentially become a premium and not a discount. So that 35 basis points, it's 1/3%. That could quite easily become a premium. That could all be swallowed up by a 0.5% cut in the rates. We wouldn't see anything feed through into the 5-year mortgage rate. So I don't think if we see 3 cuts of 0.25%, which is what I think we probably will see over the next 12 months, then I don't think we're going to see 0.75% come off those 5-year mortgages, Dunk. I think we might see 0.25% come off the 5-year mortgages, which probably isn't worth hanging out for.